Good morning. Myself, Dr. Shukanta Sharkar. Today, I will take my last class on Block 5. Uh, the course title is Management of Financial Institutions and Services, and the course code is MGO-7023. And in last class, I discussed about various types of finance institutions like banking sectors, insurance sectors, their role, their activities. And in last block, in block 5, I will discuss about the financial services industries. And in this block, we have three units, unit 16, 17, 18. And Unit 16 basically discuss about the merchant bankings and their role activities, and Unit 17 discuss about the leasing and hire purchase and consumer and housing finance, venture capital finance, factoring services, and Unit 18 basically discuss about the credit rating and financial advisory and portfolio management services. So all these things I'll discuss in today's lecture. And I'll discuss one by one. First, block 16, then 17 and 18. And let's go. So, Unit 16 basically discuss about the financial services industries. And we know that financial service industries is the base for economic activity of any country. And it is basically expanding in developing and both developed countries, and various financial institutions, non-banking financial organizations, and various financial corporates are working under financial service industries, and they are providing various financial services and various financial products to common peoples or corporates or entrepreneurs who are involved in financial activities. So we can say that financial services industry is a vast economic sector that manage money, facilities, capital flow, and provide risk management. So we know that in industry, in business, risk management is more important. And many times entrepreneurs use a third party for reducing risk in business, and also collecting various advice and proposals for expansion of business and for reducing the risk. And risk management is a good strategy for any firms, entrepreneurs to sustain in the market, especially those firms who are new. And we can say about the startup who involve in economic sectors. So their main motives is to how reduce the risk. So in this case, various risk management firm exist, and they can help assist firm for minimizing risk in business. So in this case, you can say the bank and various non-banking financial companies also play a vital role in financial service industries for providing various financial service to entrepreneurs and common people who are involved in business. So in this slide, I discuss about the financial sectors. You can say that in India, and who are the major participant in financial sectors. So we can say about retail banks, then investment banks, insurance companies who provide insurance service, maybe life insurance, non-life insurance, investment managers play also vital role. Exchanges and clearing houses who clear various bills, draft, and government institutions, payment farms or industries or entrepreneurs or processors. So this is the, you can say, the major player in financial sector in India. So we can say that the government and both the private sectors are involved in Indian financial sector. So first, in the first unit is the that merchant banking. So what basically indicate the merchant banking? So basically, merchant banking refers to financial institution that specialized in capital raising, underwriting, and advisory services for corporations and high net worth individuals. So basically, merchant banking are one type of firms so who provide various services in terms of how capital will be arise, how risk will be uh, minimized, and how product can unstock product can be sold, and how any firm can quickly generate income, and what and various types of financial advice are also provided by the merchant bank. And in India, the merchant banking system is basically controlled by the RBI and also Security and Exchange Board of India. So merchant banking activities firms, they are controlled by the SEBI merchant regulation, merchant banks regulations. They are controlled by the SEBIs, and merchant managers are involved for providing advice and income generation for firms who are involved in financial sectors. So I write here various activities of merchant bankers, like they basically industrial focus, and they provide advice. They involve in uh, market sellings of various products, income generations. They are always involved in how this can be minimized. And in this case, I discussed previously one important role of merchant banks, we can say, are the underwriting or merchant managers, they involved in the underwriting. So, what mean by underwriting? So, basically, we can say that underwriting is the process where financial institutions evaluate the risk of a proposed financial transaction or applicant. In exchange for a free interest rate or premium, the underwriter assumes the financial risk and determine the exact term or pricing for the deals. So underwriting basically is a technique through which merchant managers identify what type of risk basically involved in any financial transactions or in any deal, what type of risk involved and how those risks can be minimized. So underwritings by a merchant bank is a risk management process where a financial institute guarantees the sale of a corporate client's new securities if the public or investors do not buy all the offered shares. The merchant bank commits to purchase the remaining portion themselves. So, in underwriting, merchant bank also give a guarantee, and that if any stocks is unsold in the markets, then they will purchase those stocks. So, in this case, selling this problem will be solved by the merchant bank, and in exchange they charge free premium or interest rate. So we can say that merchant bank provide one type of guarantee for any corporate clients. So for regarding selling of the stocks or bonds, so if any unsold stock or bond exists, then they will purchase. So ultimately, the stock and bond of any firm will be sell in the market. So that's the way. So the such a guarantee basically provided by the merchant bank. And I said previously, the merchant bank in India is basically governed by the Securities and Exchange Board of India (SEBI) to protect investors and ensure market integrity. And SEBI enforce two type of category, who are covered merchant banking, so about their amount, and at the same time we can say that merchant banking activity in India also under governed by Companies Act. So in this case, they are not free. So they are always observe. They follow whatever criteria or guideline imposed by the Security Exchange Board of India (SEBI), and at the same time, whatever mentions in criteria in Companies Act. So in this way, we identify that merchant banking play a vital role in financial activities, basically solving financial problems and minimizing risk and the risk of selling stocks and bond in the market. Next, we can say about this is the Unit 17. It basically discuss about the leasing and hire purchase. So we identify there are many leasing firms are there, hire purchasing firms are there. So what mean by the leasing and hire purchasing activity? So leasing and hire purchase are both method of financing expensive assets without paying the full cost upfront. So basically, we identify that nowadays there is a common tendency for the people that they can use any product, and people want to purchase any product without paying the full amount. So many times people also use various assets without purchasing that assets. So in this case, leasing and hire purchase play the vital role for solving such a problem. So many times people do not have enough money. So in this case, it is possible that they cannot purchase the product, but they want to use that product. So in this case, leasing played a vital role. And but in leasing, there will not be any ownership right. You just use that product, and you obviously pay some charge and premium or interest rate for using that product. So there is also cost for using the product. So basically, it means the leasing and hire purchase basically indicate that you may use the product, but you pay the price of the product continuously, and ultimately you may have the ownership right of that product. So in this case, we can say that in hire purchase, it linked with ownership rights, and but in leasing there is no ownership right. You only use that product, and you bear the cost for using that product. So in details, I'll discuss now what is the leasing and various types, and hire purchase. What are various types? You can see that leasing types, actually leasing agreement are highly flexible and basically broken in two categories. We can identify that there are two types of leasing system exist. One is known as the operating lease, and second one is the finance lease. So operating lease basically it link with a time frame, the short period. You use any product for the short period, and in finance lease you use any product for the long period. You remember, you are not the owner of the product. You just use the product of another person. It may be for the short period or maybe for the long period. And if agreement is on the basis of short period, so it is known as a operating lease. And if agreement for a long period, it is known as a finance lease or capital lease. So operating lease is a short-term agreement where the rental period is much shorter than the asset's economic life. The leaser usually bear the maintenance and insurance cost. It means who is the owner of that asset, he basically bear the maintenance and insurance cost, because period is very low. Many times we see that we hire car, we hire that various machines for a very short period, maybe one day, maybe 1 weeks. So it is such type of leasing, the operating leasing. So in this case, the maintenance cost, so and the risk of insurance, or all those things bear by the owner of that car or machinery. So we just want to use that machine or car for a certain short period of time, and in this case, whatever that cost is there, I will pay that person who use currently that asset. He will bear the cost. So it is known as a operating lease, but opposite happen in case of the finance lease. So finance lease or capital lease is a longer term agreement where that person who use that assets, he will bear the risk for risk of insurance or whatever damage, maintenance, all cost bear by that person. So in this case, who use that product, he will bear the risk or insurance or maintenance, whatever cost that person will be bear. And the condition is that person use that product for long period. And it is possible that after a long period of time, that person may purchase that asset. It is possible, and if that person purchase, it will be very low price. That person may purchase, and it is possible that that person may purchase, then sell this product to any third party. It is possible, or it is possible that after a long period he will continue use that product without purchasing. So many things is possible after a long period. So it is known as a finance lease. So in this case, you identify that leasing is a basic term. You can say any person use the product or asset of another person for a certain period of time. And in this case, the period of time may be short and may be long. And if period of time is short, it means it is short period agreement between the two parties. It is known as the operating lease. And if agreement is for a long period, and it is known as a finance lease. And in operating lease, there is no commitment that in future you will purchase the products. There is no commitment. So in operating risk, whatever insurance cost, maintenance cost, the owner of that farm will, or owner of that assets will be bear the cost. But in case of financial lease, who use currently that product, he will bear all types of insurance and maintenance cost. And there is a possibility that after the ending of the term, so it is a long period, it's a long period agreement. So after the agreements, you may purchase that asset at very low cost, and it is possible that you may sell this asset to a third party and also earn some income. So many things possible in case of the leasing. And second one is the hire purchase. So I discussed previously also. Hire purchase means you use the products, yes, you use the product, and ultimately you will be owner of the product or owner of that the commodities in future. So it is one day assurance that you can say ultimately you will be the owner of that product. So it vary from time to time. So it may be after short period or maybe a very long period. And there is also a scope that you bear the price of that product, and various installment is there every year, every month it is possible. You may give the installment in terms of the price of the products, and it will be continue maybe short period or maybe long period. Installment amount also vary. So, on the basis of this, hire purchase can be classified in two ways. First one is the standard hire purchase, and second one is the balloon hire purchase. So, there are two types are there. In standard hire purchase, so basically what happens, for example, you can take standard hire purchase for purchasing a bike. So nowadays it is more popular for the people that people purchase various bike, various commodities they will purchase. So initially what they will do, they will give some initial deposit sum. So it is not only down payment. So maybe 5%, 10%, 20%. So it is in terms of the down payments, and then thereafter they give the fixed monthly installment. They will pay. Suppose you purchase a bike from the showrooms. In this case, they will ask for the down payment, and then remaining amount you will pay in monthly installment. And this installment basically cover the asset value plus interest. And ultimately, the ownership right transfer automatically to that person after paying the final installment. So after paying the final installment of the bike, so it then document will be transferred to you, and then you can say this is my bike. So before paying the final, that payment, so you cannot claim that this is my bike. So this is known as a standard hire purchase. So in this way, that any person can purchase any product without paying the full payment. So by paying down payments and then remaining in installment, any person can purchase the products. Second one is the balloon hire purchase. So in this case, the basic difference is the installment amount and duration. So in balloon hire purchase, the main feature is the lower monthly installment, because a large that the amount will be paid in future. And in this case, it is possible that at the end of the agreement, whatever amount is left, you pay the lump sum whole amount, and then you can claim the ownership right of that product. Or it is possible that you may refinance, you may sell that product, because it will be your product, you will ownership it, you may sell this product. So in this way, we can say hire purchase can be classified in two ways. Standard hire purchase is a normal process. You pay the down payment, and every month you pay the installment, and after paying the final installment, you will be the owner of that asset. And the balloon hire purchase, in this case, that monthly payment will be low, because the monthly payment okay at the end of the payment, whatever left payment is left. So it may be a bulk amount or whatever remaining, a lump sum amount we will pay at the end of the contracts, and then you can claim the ownership right. Consumer housing finance. So consumer and housing finance refers to the credit system that enable households to manage expense and acquire properties. Consumer finance covers short to medium term credit for everyday goods, where housing finance involves long-term mortgage for purchasing or constructing residential real properties. So in this case, you identify there are the two type of finance are there. One is the consumer finance, and second one is the housing finance. So consumer finance basically provides short and medium term loans. In this case, there are many firms exist in the market. Various financial institutions exist in the market who provide the consumer finance. So basically, they provide a short and medium term loan for purchasing various goods, commodity. We can say about the car. We can say about the various the commodities, various electronics goods, you can say the bike, we can say about the various electronics product you can purchase. And in this case, that firm will provide the uh, short and medium term loan. And but housing finance basically they provide the long term loan, and it is not unsecured loan, it is secure loan. So you should pay the mortgage. And in this case, they will provide you the loan for long periods. Basically, they provide loan for construction purpose, purchasing house. Then monthly basis you repay the money in terms of the installment. And in India, the consumer and housing finance, this market is expanding very rapidly due to increasing income of common people in India, and due to increasing disposable income and rapid uh, expansion of cities, we can say the urbanizations and the strong government activities. So this sector is expanding very rapidly, and currently the market price of consumer and housing finance in India, it is nearly 385 billion USD. So it is very high, and it is rapidly expanding in India. And in India, there are many type of non-banking financial corporations and specialized housing financial companies exist who involve in consumer and housing finance activities. Like example, we can say about the Bajaj Finance for providing loan for purchasing durable products. We can say about the LIC Housing Finance, Bajaj Housing Finance, PNB Housing Finance. They basically provide the fund or loan for purchasing house or various types of real assets. So in this, you can identify that consumer and housing finance that firms basically involved for providing loan to common people. And now matter is which type of product we purchase and duration. So in case of consumer finance, basically they provide the loan short and medium time for purchasing various types of durable goods. And in case of housing finance firm, they provide long-term loan and secure loan in this case for construction of house or purchasing of the house, for purchasing of various assets. They provide the fund. And in India, that consumer and housing finance is regulated and controlled by the Reserve Bank of India and the National Housing Bank. This is the apex, you can say, that bank or institution will supervise the activity of housing finance. So in this case, you can say that RBI basically monitor the growth and implement various policies for expansion of consumer and housing finance in India. Next, we can say about the venture capital finance. So what is this and how this type of finance is more important for the growth of any economy? So we say that nowadays the startup scheme is more important for any country like India. Therefore, government always promoting the startup schemes and startup enterprise. So startup enterprise basically means the new type of enterprise. So young people, energetic people, or unemployed people, they can start new type of the business, and this is known as a startup. And a startup is more important for growth of the economy because it is helpful for creating employment. It helpful for creating new type of goods, supply of new type of goods in the markets. And but the problem is for such type of startups for the initial stage, for the middle stage, or for the later stage, they need fund. So from where they will get the fund? So there should be separate institutions so who look after the financial problem of startup, or you can say about various types of enterprise. So this is known as a venture capital finance institutions. So basically, venture finance capital institutions basically they provide fund to entrepreneurs, or you can say startup for running the business. So basically, they solve the financial problem of various enterprise or startups. And when they provide funds, so how they will get benefits? So eventually, capital fund providers or institutions, they provide a fund, it's correct. So before providing fund, they always scan or monitor the startups. So what is the future prospect of that startup, or what is the future prospect of that enterprise? So if future prospect is good, they want to invest their money. And because every firms, every investors, the main motive for investment is earning profit. So if there is no profit, they do not want to invest So basically, so before investment is scrutinized the future prospect of startup or enterprise, and if they examine that yes, it have a good future prospect, basically they want to invest money in their startup or enterprise. And in this case, the venture capital finance institute they purchase the shares of the new startup firm or enterprise because the share price of new startups or enterprise is very low. So in this case, they will purchase a bulk amount of share. So share when they purchase, they also get the ownership rights of that firm. And in future, so when that farm will grow, and then their share price also will be increased, and then that venture capital finance institute who invest money, they will get benefit because in future when share price will be increased, then their revenue, their income also will be increased. So this is the you can say that the main motive for investment of venture capital finance institute. And it is also correct, and they invest money in the initial stage, and they also bear risk on their investment, and they bear risk, and there is more possibility also. They also earn huge revenue when share price of those enterprise increase or raise in future, and they will get more benefit. Next, you see that the stages of venture capital funding. So, what are the stages? So, funding. So, basically, stage here indicate the stage of that farmer enterprise, or you can say that startup farm. Pre-seed or seed stage. So, basically, it is very early stage of an enterprise. Suppose any new enterprise is a startup. In the initial stage, it is. So this is the early stage of any farm. So funds are used for initial operations, building properties, and also market research. So in initial stage of any enterprise, they also need fund for expansion of or set up infrastructures, for market research, for running their business. So in this case, they collect fund from the venture capital funding organization. So it is known as a pre-seed and seed stage. Next one is the early stage. It means serial A. So this next stage is known as a early stage. So the company has a product and is beginning to see a transaction or revenue. So already product is launched by that firm, and that firm also earning some revenue. Funds are typically used to scale the product and expand market reach. So basically, so that farm, that enterprise already started productions, and the next target of that farm is to expand the business, to increase productions and to capture more market share. So in this case, for increasing productions, that farm may need to purchase the machines, need to expand infrastructure, so that farm need capital. So in this case, if venture capital fund received by that farm, it is known as the early stage. Growth stage is the third stage. You can say series B onward. The company is already established, and the funds are basically used for increasing market share and increasing production very rapidly. So in this case, venture capital finance corporations or institute they also provide fund for this purpose. And the late stage is the final stage. The company is typically generating huge amount of revenue, and they want to purchase other firms, and or they want to launch a new IPO in the market. So in this case, they also need fund. So we identify that in every stage, fund is required. So either for expansion of the business, or increasing market share, or purchasing new machines, increasing productions, or for infrastructure development. So in this case, the farm or enterprise or startup they collect fund from venture capital finance institute. And I said previously, they also but institute also purchase share of this new farm, and so that in future when share price increase, they also get benefit. Key pillar of the market. So ultimately, whatever I discuss, what I identify. So I identify that we can find out the housing finance institute. We can find out consumer finance institute. We can find out venture capital finance institute. So these are various institutes which active in Indian financial market. So housing finance corporations like LIC Housing Finance, you can say HDFC Housing Finance. So basically, they provide very long-term loans up to 30 years. They provide loan for purchasing or construct, or you can say that purchase any assets like land we can purchase, on any property we can purchase. So they provide the very long-term up to the 30 years loan. So in this case, mortgage is essential for receiving such type of the loan. Consumer finance, as I previously, this is one type of short or medium term unsecured credit provided to individual for purchasing various commodities and services like purchasing car, purchasing bike, purchasing various electronics products, purchasing various equipments, machines. So in this case, people can use, and basically that the rate of interest is higher for consumer finance and compared to the housing finance. So in the housing finance, rate of interest is low compared to the consumer finance. So consumer finance is one type of personal loan. So in this case, you know that interest rate is high, and it is possible that you will pay the money later. So it is known as a buy now, pay later. So you can return the loan in terms of monthly installment, and interest rate also at in the monthly installment. So this is more popular among the people in India. So because currently they can use the product without paying the full price. So these are various, and I said previously also venture capital finance institute, they providing fund for enterprise, for expansion of their business, for uh, increasing market shares, for expansion of new infrastructures, purchasing new machines. So basically, venture capital fund required by entrepreneurs for running the business. Next one is the factoring services. So factoring services also very useful for any enterprise for earning quick revenue. So many times it is possible that working capital is more important for any firm for running the business. So if money is trapped of any firm for long period, then they will be loser. So in this case, factoring servicing is more important for any firm for quick earning for any firm. So how it operate, I will discuss now. Actually, factoring service allow businesses to sell their unpaid consumer invoice to a third-party financial institutions at a discount. This converts credit sales into immediate working capital without waiting for the consumer's payment due date. So this is most important. So basically here what happened, the producer, they sell the product to customers. The customer not pay the full amount initially. So there is a invoice of the customer. Suppose 50% money they paid and 50% money they will pay later. So in this case, whatever, that farm to sell the product, he not wait for 1 month, 2 months, 3 months for remaining collection of 50% of the money. So whatever you do, that this unpaid amount, so in terms of invoice, he will sell this to the third party. So third party will pay initially that 50% money at a discount rate. So third party maybe charge some commission maybe there, but they provide the remaining money. So at a discount rate. So in this case, whatever the producer farm, they immediately receive the money and they can use this money in their business. So there is no waiting time for the farm for receiving the remaining amount of the money. Factoring is highly beneficial for a small and medium-term enterprise, manufacturing companies, startups, and business deals with long payment cycles. So they do not wait for the long period for receiving the remaining amount. So quickly they are able to receive the fund, they can use that fund for expansion of the business. So we identify that these are the various types of financial institutions who provide various types of financial service to enterprise, startup, or business communities. And it is very essential. And we know that the financial activities is more important for growth of any nations, growth of any states, and for expansion of the economic activities. And in this case, such type of financial institution play a vital role for expansion of business in any economy. So I have completed, that second unit also. That actually first and second unit discuss about various types of that financial service providers, various institute who provide various types of the financial service. And last unit basically discuss about various types of advice, how fund will be expand, how any farm will be uh, increase their revenues. So various types of advice who will provide. So those farms we'll discuss in the next unit. So unit 18 discuss about the credit rating. So in this unit, I will discuss about what mean by credit rating, what is the importance of credit ratings, and what are various firms involved in the credit ratings. So all those things I will discuss here together. So basically, credit rating is an evaluation of a borrower's credit worthiness. So whether any borrowers, whether any persons actually able to repay the fund or not. What is the future prospect? Suppose in the bank also, so many people visit the bank for taking the loans or borrowings, and bank also investigate the past record, financial record of that persons, whether any default incidents happen or not. So whether that person previously taken a loan from the bank or not, whether that person repay the payment or installment in due time or not. So those things will be checked. So if record is good, so you can say there is a high credit rating for that persons for receiving a new types of the loan. So credit rating, this facility, this technique, this method basically used by bank and financial institution for reducing the future default of credits, for reducing future bad loan for any organizations. Next is the financial advisory and portfolio management services. So basically, this service, this activity provided by various organizations in India. So basically, their duty is to advise various enterprise, big firms, corporates, how they can expand their business, how they can manage their assets. So how they can manage their assets, where they'll invest their money so that their money will be more secure. At the same time, they will generate more asset for that farm. So we can say that such type of portfolio management services offer investment strategies to optimize wealth. So how any farm can increase their assets, in which area that farm will invest their money. And in India, all portfolio managers must be registered with SEBI and are subject to mandatory disclose and annual audits. So in this case, those farms, those managers who are involved in this service, they also should register with SEBI and also disclose whatever assets they generate from such type of services. Financial advisories, and next I'll discuss about the debt portfolio services. Financial advisory basically indicates here how uh, assets will be managed, how income will be generate, how in which area money will be invested, so that future goal and objectives of any persons will be fulfilled. Like as they also provide the customized planning service, asset allocation service. So customized planning service basically means advisor assess the current income of that person's risk tolerance capacity, also what is the long-term goal of that persons and how those long-term goal can be achieved by using the current income of that person. So in which area the current income of that person should be invested so that the long-term goal of that person should be achieved. So long-term goal may be here for maybe retirement plan of that person, child education or asset plannings, uh, expansion of the assets. So this is the long-term goal. So how this long-term goal can be achieved by properly manage or properly utilize of current asset of any person. Asset allocation basically indicate the advice to any person that in which area those assets will be utilized. So you know that the asset can be invested in many areas. In some areas, risk is more. In some areas, risk is low. And if risk is more, obviously the hope that return also will be higher. And secured area, risk is very low, but return is also very low. So in this case, advice may be invest money in mix up in equities of where the risk is very high, return is also very high in debt. in-depth instruments where the risk is low, return is also low. They can invest in gold also. They can save money in term bank deposit also. So in this case, when you save money in the bank, it is more secure. At the same time, return is also less. So in this case, financial advisor basically give advice to invest assets in a mixed portfolio. So you invest money in some risk areas and some secure areas so that you're able to overall risk will be less, and at the same time you should get a or generate a handsome amount of revenue. And these are the main things. And next, I discuss about the portfolio management services. So same thing I discussed previously, how portfolio will be managed. And in case the most important thing is in portfolio management services, minimum portfolio should be you have the 50 lakhs. So in this case, as per the SEBI criteria, and how this amount of money should be utilized, should be invested in various diversified areas so that the risk will be minimized and return will be high. This is a matter of advice provided by the advisor. Types of PMS means portfolio management services. So three types you identify here: discretionary, non-discretionary, and advisory. So in discretionary, all work done by the basically the advisors. So advisors provide the advice via investments. So execution part of decision also do by the advisors. So who is the owner of the assets? So he give all the rights to the advisor to look after the assets. So advice and execution all work done by the advisor. So it is known as a discretionary. And non-discretionary basically indicate that the managers suggest ideas, but trades are only executed upon due approvals. So that person who is the owner of the assets, so he give the approval, then only you can say that execution part will be implemented. So in this case, the work divided 50-50 between the two parties. So manager give the advice, but final executions, final uses of the assets will be depends on approval from that person who is the owner of the asset. And advisor is the third one. The manager provides research and advice while you take full responsibility for trade execution. It means the owner of the assets, he will take all the decisions. Only the advice this part will be provided by the advisor. So in this way, I have complete my discussions. So basically, this is the last block, and in this block, basically discuss various types of financial institutions. So basically, who provide additional service and who provide the various typical service to any firm for minimizing the risk in business. So thank you. So from this block, short type questions, maybe 5 mark question also may become like as what is underwritings, define the hire purchase, what is mortgage, and those things we will study, and what mean by lease, what are various types of the lease, what are various types of the hire purchase, and what is venture capital. So all these things we will discuss in this block. And underwriting, I said previously, so underwriting is one way for minimizing risk for any firm. So in this case, underwriting companies will purchase bond shares of unsold bond and share of any firm, and in this way, that the risk would be minimized for any firm. So it is one way of providing guarantee to any firm that if that firm unable to sell bond or securities, then that underwriting that firm will purchase the remaining amount. So in this way, I have completed this block. And what is define hire purchase? I discussed previously also that hire purchase is a process for purchasing any asset. In this case, you purchase now and pay the money later. So some down payment you may give now, and the remaining payment you pay in later in terms of monthly instrument. Nowadays, it is more popular. That many times people purchase car, purchase bike, purchase various types of asset also, and in this case, full payment not done by currently. So in this case, down payment maybe 5%, 10%, maybe give for 20%, maybe given remaining payment we will be doing in terms of monthly instrument. And various firms are there who look after this financial matter, and These are the basic concept of this block, and thank you. And in assignment copies, questions already I think allocate to you, and correctly you write the answer of the assignments, and you also prepare the multiple choice. Very simple multiple choice maybe will become from your syllabus, so you prepare accordingly, and short type questions also. So thank you and best wishes for your exam, and I hope you will get a very good score in exam, and best wishes for your exam. So thank you.